Hello everyone, welcome to AM Finance Academy. So today I am making a very important videos that everyone is I think needing it in the future especially. Okay, so whatever the thing may be. Actually काल में एक बहुत अच्छा वीडियो बनाया था तो फाइनेंशियल मैनेजमेंट के ऊपर एक्चुअली सब स्टूडेंट और फ्रेशर सोच रहे होंगे कि क्यों फाइनेंशियल मैनेजमेंट हर बार क्यों फाइनेंशियल मैनेजमेंट इसका इम्पोर्टेंस आपको थोड़ा मैं कितना वीडियो ज़्यादा वीडियो बनाने के बाद ही आपको पता चल जाएगा कि क्यों ये बार बार रिपीट कर रहा हूँ. सो आज एक्चुअली हम स्टार्ट करेंगे कैपिटल स्ट्रक्चर के बारे में. So that is also a part of financial management. Okay, so what is capital structure? I'm going to make this video on capital structure fully. So तो पूरा लास्ट तक देखिए. So skip मत कीजिए क्योंकि it's very important for you. So let's start. Okay, is capital structure. Structure means arrangement. Capital means the money invested into the business, that is capital. Okay, so capital structure means the arrangement of money or arrangement of funds. So that company keeps it for its future uses. So the capital structure means, I have said you before, that the company raises money from two sources specially, that is equity or debt. So the combination of equity debt is nothing but capital structure. That means the company raises money through equity and debt, and the combination of both equity and debt is known as capital structure. So what the capital structure should be? So capital structure should be like, you have heard about optimal capital structure. So what does it mean exactly? Optimal capital structure means actually a finance manager should choose the portion of equity and the portion of debt in such a way so that the cost of capital will be minimum and the profit will be maximum. That means the company it will have a best balance of equity and debt, so that the cost will be very minimum. Comprises of equity shareholder funds, preference shareholder funds, debentures, other long-term funds, and loans. All these things. So what is equity share, what is preference share, I think you must have studied in your academics. So but I will make another video on this, especially equity share, preference share, debenture, all these things, because these are the very important things for finance students, because all these are specially asked in the finance interview especially. So these are very important. So I will make another video on that. But only you should know that equity, that means equity share capital, and other things like preference share or debenture or other long-term loans or other long-term funds or something like that, they are the part of the debt. So okay, so having a optimal capital structure or a balanced capital structure, actually why it is needed? Because it is needed for maximization of profit, for minimization of cost, for productivity, enhancing its productivity, or enhancing control over the firm, for stability of the firm, for solvency of the firm, and liquidity of the firm. All these things, optimal capital structure is needed, must. So we can say that the relationship between equity and debt is also capital structure. So I have said you before, the risk of debt and risk of equity. Actually equity are the owner of the company. Suppose आप इस तरह सोचिए, आप एक बिजनेसमैन है, आप खुद का पैसा बिजनेस में डालते हो तो कोई प्रॉब्लम नहीं है, अगर नुकसान हुआ तो आपका है, लेकिन आपको भी ज़्यादा प्रॉफिट मांगता है क्योंकि इसी वजह से कि आप पैसा इन्वेस्ट किया है, आपका टाइम इन्वेस्ट हुआ है, ऑल दिस थिंग्स. बस दिस इज इक्विटी when you are investing on your own. So debt, if you are coming back to debt part, आप दूसरे किससे उधार लिए हो, like companies also taking loan from the banks, other financial institutions, or issuing debentures to the public. So all these things, जब आप दूसरे किससे उधार लेते हो उसको आपको कैसे भी तरह आपको पैसा वापस करना ही है, आपका प्रॉफिट हो या लॉस हो उससे कोई मतलब नहीं है उसका, क्योंकि वो आउटसाइडर से उसका बिजनेस में कुछ लेना देना है, उसको बस इंटरेस्ट चाहिए और उसका पैसा चाहिए. सो इसी तरह बिजनेस को भी उसको देना है, लेकिन उसको फिक्स्ड इंटरेस्ट, लाइक यू आर टेकिंग ए लोन फ्रॉम द बैंक एंड बैंक इज चार्जिंग 8% or 9% of interest. Like that also company will be giving that much amount of interest to their outsiders, like to banks or loan financial institutions from whom it is taking loan. When shareholders are investing fund, that is against that, when we are giving them return, that is called as dividend. Like portion of profit distributed to the individual shareholders are known as dividend. So this is the cost of equity. That means if shareholders are investing or equity shareholders are investing, against that what we are giving them, that is dividend. When we are paying to the outsiders, like to debt part, like to banks, loans, financial institutions, or other long-term funds or debentures, we are paying them interest. which is fixed in nature especially. So this is the cost of debt. So cost of equity is dividend, cost of debt is interest, you can say. So cost of debt plus cost of equity is equal to cost of capital. Are you getting that? So the main objective of optimal capital structure is to reduce the cost of capital. So cost of capital is nothing, it is the summation of cost of equity and cost of debt. So now I am going to elaborate it in a better way so that you can understand what is capital structure, and the difference between, also another thing is their financial structure. The difference between capital structure and financial structure is when we are adding short-term loans and short-term investments or all these things, that becomes financial structure. In capital structure we are adding only equity and debt, that is long-term in nature. But if we are adding the short-term, that becomes the financial structure. So suppose I can say that, suppose company is issuing three things first. Just remember it, okay? Just look at this. When a company is issuing equity share, that is worth 4 lakhs. Preference share 2 lakhs, and the total, suppose become total issues, suppose we are taking it 100%. So equity share is 4, so that is 50%. The company has issued 50% equity, 25% of a preference share, that is 2 lakh, and 25% of debentures, that is 2 lakh. If you will add all these things, 4 to 2, that will be 8 lakhs. That is 100%. Or breakup, if you are breaking up that percentage, that 50% is equity, 25% is preference share, and 25% is debenture. So by summing of all these things, we are getting 100%. So this 100% is nothing, it is, we can call it as capitalization. Okay, so this is the capital structure. That means equity share plus preference share plus debenture, because these are the part, like equity share is equity and debt, preference share is also somehow, this is in between them, and debenture is debt or other long-term loans also, we can say. If you add another 2 lakh in long-term loans, then we will have 10 lakhs. We can say that also, that is capital structure. So by adding this, we can say so capital structure is equity share plus preference share plus debenture plus long-term loans, like 4 2 is 8 lakhs or 10 lakhs, whatever, if you add long-term loans. Okay, so this is capital structure. So capitalization is, that is 8 lakhs, that you can say it is capitalization, because we are capitalizing the profits over here. So when a company collects how much share issued and how much money collected on behalf of that issue is called as capital structure. That means how much share it has issued, how much money it is collecting from that equity share and from the debt part. By summing of all these things, we can say that it is capital structure. Okay, so we are getting that capital structure is, suppose 10 lakh, yes or no, like equity share 4, preference share 2, debenture 2 lakhs, and long-term loans 2 lakhs. We are getting 10 lakhs as capital structure. Okay, retained earning, we have retained earning 1 lakh. Okay, and short-term loans 1 lakh. If we add retained earning and short-term loans to the capital structure, it becomes the financial structure. Are you getting, guys? So this is the what financial structure is. Both long-term and short-term debt part and equity part, will some of these, it will be the financial structure. So capital structure and financial structure. Actually, we can say that in this type, like financial structure is the mix of short-term liabilities, short-term debt, long-term debt that a business used to finance its assets and equities. So long-term plus short-term debt and equity is equal to financial structure. Okay, so capital structure and financial structure we have known today, and capitalization also I have said you. Capitalization means we are capitalizing the things like equity share, preference share, and debenture or long-term loans, we can say. So I have said you the cost of equity is dividend, the cost of preference share also, we are giving a fixed dividend to the preference shareholder actually, but equity shareholder, they are getting their dividends as per the profit and loss made by the company, and we are giving the fixed percentage of interest to the outsiders, that is to the debt holders especially. So the total cost or cost of capital will be cost of equity plus cost of debt, like dividend plus interest. So the optimal capital structure means we have to reduce this much, like the risk part. Yes, I am coming to the risk part. If you will not give right amount of interest to the outsiders like debt holders, so they may be charged on us, because they are not the owner of their own company. At any cost they need money, so this is a risk for the business. But equity, when we are coming back to the equity part, as they are the owner, they can manage the loss made by the company. But when debt part is not, so debt is risk. But equity, we are coming back to equity, they have high expectations as their owner. Their expectation must be fulfilled. Otherwise they will withdraw their fund because they are the owner. They are managing the loss, is right, but we have, we have the responsibility, or the finance manager has the responsibility to give them more profit than the outsiders, that the debt holders. That means whose cost is higher? Equity cost is higher. That means we have to give more dividend in comparison to debt part or interest part. As it is fixed, we have to give them fixed back. When the profit will be higher, the equity shareholders also, they will also want more dividend. So by actually the finance manager, the main work of the finance manager is to, it will raise the money from equity and debt in such a way so that the cost of capital will be minimum. Like cost of equity and the cost of debt will be very minimum. So this is what capital structure, capitalization and financial structure is. I think you must have understood this. Actually, why I am telling this, because we go to every interview, especially there is maximum chance that they may ask you like what is financial management, what is capital structure, what is financial structure, what is equity share capital, or what is preference share capital, what is debenture, what is long term loans, all these things. So I have said you, I will make definitely I will make all the videos like the questions related to finance interview as per my experience. I have faced so many interviews in finance companies. So whatever the question they are asking, I must upload. Very soon I am going to make that videos also. So don't worry. So see the video and enjoy. Okay. So if you are liking this video, आपको video अच्छा लगा है, तो don't forget to subscribe. Okay, share this channel, like this channel and watch the full video. Don't forget to subscribe. Thank you.